Active income is what you earn while you're awake. Passive income, on the other hand, is what you make even when you are asleep. Active income depends on your work, and passive income depends on your knowledge. And first of all, let me share my own journey. In 2018, I earned $2,107 in passive income. In 2019, that grew to $18,182. By 2020, by 2020, it jumped to $54,480. In 2021, it was $56,803. And by 2022, I made $134,373. And in 2023, it reached $159,254. So far in 2024, I've already earned $140,000. And as you can see, passive income starts slow, but it grows quickly, like a snowball. But only if you have the right knowledge and use the right methods. And here's the process. First, you start with any passive income. You don't work, so you don't earn. And then you go to active work. You work hard to make money. But more importantly, you invest that money with knowledge until you reach passive income. Because this is when your money starts working for you, improving your quality of life, freeing you from the grind. And in this video, I'll break it down into 3 simple parts. First, how to calculate your income goal. Second, how much you should save and invest each month. And 3 strategies to achieve passive income with investments. Before starting, don't forget to like, subscribe, and leave a positive comment just below. So let's go on. Let's dive in the first part, calculating the goal. It's actually pretty simple. Are you happy with the money you're spending today? If you're spending $5,000 a month and you feel comfortable with that, then that should be your target for monthly passive income. Now, if you want a different lifestyle, go on more trips, eat in fancy restaurants, buy luxury stuff, you need to set a higher goal. The higher the goal, the harder it will be to achieve. But the payoff is a more comfortable future. Don't forget that if you're in your 20s or 30s, don't just settle for what seems like a good retirement number. Life changes a lot over the years, so it's important to aim higher. You should aim higher. And for those in their 40s, it's a good idea to add about 30% to your target income, just as a buffer. Another consideration when planning for the future is inflation. If you're aiming for $20,000 a month, keep in mind that 30 years from now, that $20,000 won't have the same value because prices will rise over time. The key is to adjust your monthly investments to account for inflation, assuring you are financially secure when you reach your retirement goal. Alright, let's do the math. Here's a simple formula to calculate your retirement target. Monthly income times 300 equals your retirement income goal in dollars. And for your timeline, age of retirement minus current age equals time remaining to reach your retirement goal. For example, if you want $5,000 per month in retirement, you multiply $5,000 by 300, which equals to $1.5 million. So you need $1.5 million saved up to support a monthly retirement income of $5,000. Just subtract your current age from your planned retirement age. If you're 30 years old and want to retire at 65, that leaves you with 35 years to reach your retirement goal. This gives you a clear idea of how much you need and how long you have to save or invest to hit that target. Now let's move on to the second part of this video, understanding average returns. Before setting up a strategy for monthly investments towards our goal, we need to establish an average return rate. Even a small difference in return can either save us years or force us to work longer. Imagine aiming to retire in your 60s, only to discover a year before that it's not enough. You don't want to be in a position where you have to keep working indefinitely. To give you a clearer picture, here's a breakdown of the return for the S&P 500, MSCI World Index, US REITs, and US 10-year Treasury bonds over the past 10, 20, 30, 40, and 50 years, both in nominal and real inflation-adjusted terms. I'll put this information on the screen. First, S&P 500. 10-year nominal return, 12.24%. Real return, 9.74%. 20-year nominal return, 9%, and real, 6.8%. 30-year, 10.7%, and 8.2%. 40-year, 11.8 and 9.3. 50-year, 10.3 and 7.8. Now let's go to the MSCI World Index. 10-year nominal return, 8.92%, and real, 6.42%. 20-year nominal return, 7.3 and 5.1. 30-year, 7.5 and 5.2, and 40-year, 8 and 5.5%. Let's go to the US REITs and talk about real estate. 10-year nominal return, 9.08%, and real 6.5%. 20-year 9.5 and 7.3, 30-year 10.3 and real 7.8, 40-year 11% and 8.5%. Now let's go to the US 10-year Treasury bonds. 10-year nominal return is 1.84% and real return a negative 0.66%. 20-year 2.6 and 0.4%, 30-year 4.4 and 1.9, and 40-year 5.5 and 3%. So why did I just set all of that? Based on this, aiming for an average 10% annual return is a solid assumption for planning. Now, there are two ways to calculate how much you need to invest. First, we use the compound interest formula to find out how much a single investment grows over time. I'll put the formula on the screen, but it's A equals P times 1 plus R divided by N raised to the power of N times T. So this formula is useful when you already know how much you are aiming for and want to invest a lump sum to reach that goal. Let's go through an example. You start with $100,000. The interest rate is 10% annually, compounded quarterly, and you plan to leave the investment for 20 years. So in the formula, P equals $100,000, R equals 0.10 or 10%, N equals 4 since it's compounded quarterly, T equals 20 years, and now plug all those numbers into the formula and you have 100,000 times 1 plus 0.10 divided by 4 raised to the power of 4 times 20. This equals approximately to $732,000. So after 20 years, your original $100,000 will have grown to about $732,000. The second way to do it is calculating how much you need to invest regularly to reach your goal using this formula. It's actually not pretty simple, but you can use a calculator to do it, or even ChatGPT. It's just PMT equals final value times R divided by N, and then all of that divided by 1 plus R divided by N raised to the power of NT minus 1. Let's look at an example. Suppose you want to accumulate $1 million over 20 years with an annual interest rate of 10%. Here's how we break it down. Future value equals $1 million. Interest rate equals 10% or 0.10 because it's 10 divided by 100. This is the reason it's called percent. Number of contributions, N equals 12 for monthly investments. Time, the T, equals 20 years. And by plugging those values into our formula, we find that your monthly investment, the PMT, would be $1,316.88. It's pretty straightforward, right? And if you need help, you can also use tools like ChatGPT, as I just told you, to do the math for you. So we covered our goal. So it's the amount we need to reach in order to retire or have a high passive income. Then we calculated how much we need to invest monthly or on a single investment to reach that goal. And now I'll show you 3 strategies to achieve good passive income. But a little disclaimer, the information provided is for educational purposes only and should not be interpreted as financial or investment advice. The examples and strategies discussed do not consider individual circumstances such as inflation, taxes, fees, or specific financial goals, and they're not tailored to your personal situation. They're simply illustrating potential strategies based on historical data. Past performance is not indicative of future results, and investing always carries risk. For personalized advice, please consult a licensed financial professional before making any investment decision. The first one, Dividend Stocks. A dividend company regularly pays a portion of its profits to shareholders, usually in cash. It's a great way to earn steady income while holding onto the stock. Within the world of dividend-paying companies, we have the dividends S&P aristocrats. These are elite companies that have not only paid dividends, but increased them for at least 25 consecutive years. So if you're looking for reliable income alongside long-term growth, these companies are solid options. Let's compare two dividend stocks. AT&T is a large telecom company known for its high dividend payouts, although it has experienced ups and downs in recent years. If you had invested $1 million in AT&T 5 years ago, based on a 5-year return of 12.30% and a dividend yield of 7.27%, but I included this 7.27% on the total return, your investment would have grown to approximately $1,123,000 considering dividends by the end of 5 years. Over those 5 years, your total passive income from dividends would have been $363,000 with an average monthly dividend income of around $6,000. However, AT&T's net worth appreciation without dividends would have been around $1,050,300. That is a modest 5.03%. Now, if you had invested $1 million in Ford Motor Company 5 years ago with a 5-year return of 44.59% and an average dividend yield of 5.2%, your investment would have grown to approximately $1,445,000, including dividends. You would have received a total of $260,000 in dividends over those 5 years, with an average monthly passive income from dividends of around $4,300. Without dividends, Ford's stock would have appreciated by 39.39%, leaving you with a net worth of approximately $1,393,000. The takeaway: while AT&T has a higher dividend yield, its stock return without dividends was minimal, meaning that without those payouts, your investment might have barely grown. Meanwhile, Ford saw stronger capital appreciation alongside its dividends, giving you a better overall return. Second, REITs. A REIT is a real estate investment trust. A REIT is a company that owns, operates, or finances income-generating real estate. They're known for their high dividend payouts, as they are required to distribute at least 90% of their taxable income to shareholders. Let's look at an example. AGNC Investment Corp, a well-known mortgage REIT focusing on residential mortgage-backed securities. If you had invested $1 million in AGNC Investment Corp 5 years ago with an 18.23% 5-year return and an average dividend yield per year of 12.65%, you would have received a total of $632,000 in dividends. Your average monthly passive income would have been around $10,541. However, AGNC's stock price depreciated by 44%, leaving your net worth at $551,000 without considering dividends. Now, let's look at Vici Properties, a REIT focused on owning and managing entertainment and gaming properties like casinos, hotels, and resorts. If you had invested $1 million in Vici Properties 5 years ago with a 5-year return of 87.77% and an average dividend yield of 5.12% per year, your investment would have grown to approximately $1,877,000. You would have received $256,000 $96,000 in dividends, with an average monthly passive income of around $4,266,000. Without dividends, Vichi's stock would have appreciated by 82.65%, leaving you a net worth of $1,800,000. While AGNC offers a significantly higher dividend yield, 12.65%, and thus generates more passive income in the short term, the depreciation of its stock price leads to a substantial loss in net worth. Vichi, on the other hand, balances a moderate dividend yield, 5.12%, with much stronger capital appreciation, resulting in a better overall financial outcome. If you're looking for immediate income, AGNC might seem appealing, but for long-term growth and wealth accumulation, Vichi clearly comes out ahead. Third, ETFs. An ETF, an exchange-traded fund, is a type of investment fund that holds a basket of assets, such as stocks or bonds, and is traded on stock exchanges, much like individual stocks. ETFs offer diversification, allowing investors to own a range of assets in one investment. Let's compare two dividend ETFs: the iShares Select Dividend ETF, the DVY, and the WisdomTree US High Dividend ETF, the DHS. If you had invested $1 million in DVY 5 years ago with a 5-year return of 10.46% and an average annual dividend yield of 4.65%, your investment would have grown to approximately $1,104,000, and you would have received $232,000 in dividends with an average monthly passive income of $3,875. Without dividends, DVY's stock would have appreciated by 5.81%, leaving you with a net worth of $1,058,000. With DHS, if you had invested $1 million 5 years ago, your investment would have grown to approximately $1,096,000, with $199,000 in dividends. Your average monthly passive income from dividends would have been around $3,316,000, and without dividends, DHS stock would have appreciated by 5.68%, leaving you with a net worth of $1,056,000. Both DVY and DHS offer similar total returns over the 5-year period, with DVY slightly outperforming in both dividend income and capital appreciation. While neither ETF offers substantial capital appreciation compared to individual stocks or REITs, DVY edges out DHS for those seeking a little more in passive income. However, both ETFs provide the benefit of diversification and stability, making them suitable for investors with a lower risk tolerance who prefer a balanced approach. So here comes the conclusion. Passive income can be a powerful tool for building long-term financial security, but it requires careful planning and strategy. Whether you choose dividend-paying stocks, REITs, or ETFs, each option has its strengths and weaknesses. One point I would like to raise in this video is diversification. I don't think the smartest way to invest is to choose one of these options and just invest in it. You need to have a portfolio with several good options to reduce risks. If you want, I'll make a video just about diversification. Let me know in the comments. The key takeaway from all of this is simple. Do your research. Understand your financial goals, risk tolerance, and the nature of each investment vehicle before committing. No single strategy is perfect for everyone, but with the right knowledge and planning, you can build a passive income portfolio that works for you, even as you sleep. And remember, patience and consistency are vital. Your passive income won't skyrocket overnight, but over time, it will grow into a snowball that can significantly improve your financial freedom. Well, that's it, cousins. I hope you enjoyed this video, and I hope you learned something to get closer to your financial independence. Don't forget to like, subscribe for more content like this, and comment. My success is your success. See you soon.